Investing in the stock market is one of the most effective ways to build long-term wealth. While it may seem intimidating to newcomers, the stock market offers numerous opportunities for individuals to grow their financial assets over time. Whether you're saving for retirement, a major life goal, or simply looking to generate passive income, understanding the fundamentals of stock market investing can be transformative. Stocks, which represent ownership in a company, have historically provided higher returns than other investment vehicles, such as bonds, savings accounts, or real estate. However, along with the potential for greater returns comes the reality of market volatility and risk. Navigating these ups and downs requires knowledge, strategy, and a long-term perspective. This guide will walk you through the essentials of stock market investing, from understanding how it works to practical tips for getting started. What is the stock market? The stock market is a platform where investors buy and sell shares of publicly traded companies. These exchanges, like the New York Stock Exchange, NYSE, and the Nasdaq, facilitate the trading of stocks, bonds, mutual funds, and other financial instruments. When you invest in the stock market, you are essentially buying a piece of a company, giving you partial ownership and the opportunity to benefit from the company's growth and profitability. The stock market is driven by supply and demand. When more people want to buy a stock than sell it, the price goes up. Conversely, when more people want to sell than buy, the price drops. Stock prices are influenced by many factors, including the company's performance, economic indicators, interest rates, and investor sentiment. Why invest in stocks? There are several key reasons why investing in the stock market is beneficial for long-term wealth building. Potential for high returns. Historically, the stock market has provided higher returns compared to other types of investments. While there are fluctuations and downturns, the market has generally trended upwards over long periods. For example, the S&P 500, a benchmark index that tracks 500 of the largest companies in the U.S., has averaged annual returns of around 7% to 10% over the last century. Compounding growth. One of the most powerful aspects of stock market investing is the ability to benefit from compound interest. By reinvesting your earnings, whether through dividends or capital gains, you allow your investment to grow exponentially over time. Diversification. Investing in the stock market allows you to diversify your portfolio. By owning a mix of different stocks from various sectors and industries, you can reduce your overall risk and increase your chances of positive returns. Ownership in companies. When you buy a share of stock, you become a partial owner of that company. As an investor, you may benefit from dividends, stock price appreciation, and even have a say in corporate decisions through voting rights at shareholder meetings. Liquidity. Stocks are relatively liquid, meaning they can be bought and sold quickly compared to other investment types like real estate. This gives you flexibility and access to your funds when needed. Understanding stock market risk. While the stock market offers high returns, it also comes with inherent risks. The value of your investments can fluctuate based on market conditions, economic factors, and individual company performance. It's essential to understand these risks and develop a strategy to mitigate them. Market volatility. Stock prices can be highly volatile, often reacting to external events such as changes in government policy, geopolitical tensions, or economic data. During periods of volatility, stock prices can fluctuate dramatically in short periods, which may cause investors to panic. It's important to remain calm and maintain a long-term perspective during market downturns. Company-specific risk. Each stock comes with risk specific to the company. Poor management decisions, changes in consumer preferences, or competition can negatively impact a company's stock price. To reduce this risk, investors often diversify their portfolios by investing in multiple companies across different sectors. Market timing risk. Attempting to predict the market's highs and lows, also known as market timing, is notoriously difficult and can result in significant losses. Instead of trying to time the market, it's generally more effective to invest consistently over time, a strategy known as dollar-cost averaging. Economic risk. Stock prices are also influenced by broader economic factors, such as inflation, interest rates, and unemployment. These factors can affect investor confidence and, in turn, stock prices. Diversifying across asset classes, such as including bonds or real estate in your portfolio, can help mitigate some economic risks. Types of stocks. There are various types of stocks that investors can choose from based on their financial goals and risk tolerance. Understanding the characteristics of each type can help you build a more balanced and diversified portfolio. Common stocks. These represent the majority of stocks traded on the market. When you purchase common stock, you are entitled to vote at shareholder meetings and receive dividends, if the company distributes them. Common stockholders benefit the most from stock price appreciation but are last in line to claim company assets in case of liquidation. Preferred stocks. Preferred stockholders have a higher claim on dividends and company assets than common stockholders, but they typically do not have voting rights. Preferred stocks offer more stable dividends but tend to have less growth potential compared to common stocks. Growth stocks. Growth stocks belong to companies that are expected to grow at an above-average rate compared to others in the market. These companies often reinvest their earnings to fuel further growth rather than paying dividends. Growth stocks can offer substantial capital gains but are typically riskier than other types of stocks. Value stocks. Value stocks are shares of companies that are considered undervalued by the market. Investors in value stocks look for companies whose stock prices do not reflect their intrinsic worth, potentially offering a bargain. These stocks can provide steady returns but may not experience the rapid growth seen with growth stocks. Dividend stocks. Dividend stocks are those that pay regular dividends to shareholders. These stocks tend to belong to established, stable companies. Dividend stocks are attractive to investors seeking regular income, in addition to stock price appreciation. Getting started. How to invest in the stock market for beginners. Getting started in the stock market can seem overwhelming, but it doesn't have to be. Follow these steps to begin your investment journey. Set your financial goals. Before you invest, consider what you want to achieve. Are you investing for retirement, saving for a major purchase, or looking to grow your wealth over time? Defining your goals will help you determine your risk tolerance and investment strategy. Build an emergency fund. It's important to have an emergency fund in place before you start investing. This fund will help cover unexpected expenses so that you don't have to dip into your investment accounts during market downturns. Choose the right brokerage account. To buy and sell stocks, you'll need to open a brokerage account. There are several options available, from full-service brokers who offer financial advice to low-cost online brokers that provide self-directed investing. Compare fees, services, and ease of use to find the right brokerage for your needs. Start with diversification. One of the best ways to mitigate risk is by diversifying your portfolio. Consider investing in exchange-traded funds, ETFs, or mutual funds, which allow you to buy a basket of stocks instead of individual shares. This can help spread risk and provide exposure to a variety of sectors. Invest consistently. Consistency is key when it comes to building wealth through stock market investing. Dollar cost averaging, which involves investing a fixed amount of money at regular intervals, can help smooth out the effects of market volatility. Reinvest your dividends. If you invest in dividend-paying stocks, consider reinvesting your dividends. This allows you to buy more shares and benefit from compounding growth over time. Monitor and adjust your portfolio. While it's essential to take a long-term approach to investing, it's also important to periodically review your portfolio to ensure it aligns with your financial goals. Rebalancing your portfolio annually can help you maintain the appropriate mix of assets as market conditions change. Common investment strategies. There are different strategies investors can use to grow their wealth in the stock market. These strategies depend on factors like risk tolerance, time horizon, and personal preferences. Buy and hold. This strategy involves buying stocks and holding onto them for the long term, regardless of market fluctuations. The goal is to benefit from the general upward trend of the market over time. Dividend investing. This strategy focuses on buying stocks that pay regular dividends. Investors reinvest the dividends to grow their holdings over time, providing both income and capital appreciation. Value investing. Value investors look for undervalued stocks that they believe are priced below their intrinsic value. The goal is to buy low and wait for the market to recognize the stock's true worth. Growth investing. Growth investors seek companies with high potential for expansion. These stocks may not pay dividends, but they offer the potential for significant capital gains. Index investing. Index investors buy ETFs or mutual funds that track a market index, like the S&P 500. This strategy offers broad diversification and lower risk by investing in the overall market. Investing in the stock market is a powerful way to build long-term wealth, but it requires patience, knowledge, and a well-thought-out strategy. While the market can be volatile in the short term, maintaining a disciplined, long-term approach can lead to significant financial gains over time. By understanding how the stock market works, setting clear financial goals, and employing proven investment strategies, you can harness the full potential of stock market investing to secure your financial future. Remember, the key to success in the stock market is staying informed, remaining patient, and investing consistently. Over time, the power of compound interest and market growth will work in your favor, helping you achieve your financial dreams. Whether you're saving for retirement, building wealth for future generations, or looking to grow your assets, the stock market offers countless opportunities for those willing to invest wisely.